Good afternoon. My name is Paul Bennett, and I'd like to welcome you to our educational video done exclusively for the left field investor community. We're excited to have the opportunity to contribute to the community and want to thank Jim, Chad, Ryan, and the entire left field investor team for giving us this opportunity. Today, we're going to talk about yield on cost and development spread and how they may help you determine what types of real estate investment you want to make, as well as give you the opportunity to compare different opportunities that you are considering. Before we get started, I do want to give you two quick disclaimers. First of all, this video is not intended to give investment advice, and you should consult your advisor about any investment decisions. And secondly, this video is not an offer to purchase or solicitation for a securities transaction. Now that we've got that out of the way, let me quickly give you a little bit of my background as we get started. I've been in the real estate syndication industry since 1981. I started with a regional syndicator located in North Carolina, where we did multifamily and hospitality single property investment opportunities. I migrated to a New York investment bank, where I was part of the real estate syndication team there. And lastly, spent a number of years as the president and CEO of an international family office, where in addition to managing an extensive real estate portfolio, we also formed two international funds, one in Dublin, Ireland for European investors, and the other in the Cayman Islands for Middle Eastern investors. AAA Storage has historically done single property syndications. I came to AAA in 2022 to found and help form our multi-property fund platform, which we'll talk about a little bit more about a little later in the presentation. AAA Storage was founded in 1994 in Austin, Texas by John Mueck. We're focused exclusively on self-storage and office flex industrial development and property management. Over the 30 years that we've been in existence, we've developed and sold a total of 90 projects that represent over 6 million square feet and $450 million in exit value. And across all 90 projects, our average return to our investors has been a 19% IRR. We started with high net worth individuals, primarily friends and family, and that ultimately grew into a group of over 350 investors that invested in multiple projects over the years. And as I've already said, in 2022, we made the decision to begin to offer multi-property funds instead of single property syndications. Today, we're going to talk about yield on cost and development spread. We're going to try to answer some very basic questions. What is yield on cost and what is development spread? Why are they important, and how can they help you reveal value creation and investment returns in the opportunities that you're reviewing? We're going to do an overview, and we're going to talk about how you can use them. We're going to give you some examples of how you can use them to help make better investment decisions. We're going to start with yield on cost because it's the base metric. Development spread is a derivative of yield on cost. So let's answer the question, what is yield on cost? It is very simply the pro forma projected net operating income for a property divided by the cost to construct or upfit the property. And that includes the land cost. I'll give you a quick example. If an apartment project has a cost of $10 million and it has a projected NOI of $720,000, that property has a 7.2% yield on cost. I'm sure that all of you are familiar with cap rates or capitalization rates. Cap rates are simply a yield on market value versus yield on cost, which is a yield on the cost to construct a project. Why is yield on cost an important metric? First and foremost, it indicates the additional return that you can earn for taking the development risk, the risk of developing a property from the ground up versus buying an existing property. And yield on cost helps reveal the value spread between cost and market value. It's also useful in comparing opportunities with different profiles. Are you looking at the opportunity to build a property versus buy a property? Are you looking at different property types? Are you looking in different geographic markets or cap rate environments? It is used most often in ground-up development, value-add, and redevelopment projects, and fairly underutilized by passive investors When you add the yield on cost analysis to the more standard ways of looking at return, it provides some additional perspective. Cap rates look at value, which is variable. As we all know, cap rates move up and down. It also excludes capital expenditures. Cash on cash yields, another common way to look at returns in real estate investment, will vary based on the leverage terms, the terms of the debt or the structure of the debt. So it makes it very difficult to compare two different opportunities. Yield on cost looks at cost, which are fixed, unlike value, which is variable. It does include CapEx, and it does not include the variability of debt terms. What we're looking for when we look at a project is a project with above average returns and average or below average risk, essentially a dislocation of the risk return relationship. I'm going to give you a very simple example to start with. This example is two different properties. They're both development opportunities. They're the same property type, and we assume in this example, they're in the same cap rate environment. Property one, at a cost of $10 million to build, has a 7.2% yield on cost. Property number two, $10 million cost to construct with an 8.2% yield on cost. Property one, therefore, has a $720,000 net operating income. If you apply a 5.5% cap rate to that, it would indicate a value just over $13 million at sale. Property two, same market, same property type, has a higher yield on cost at 8.2%, which indicates NOI of $820,000. Applying the same 5.5% cap rate, it would have a terminal value just above $14.9 million. So you can see the additional $100,000 in yield between project one and project two creates a net difference of over $1.8 million in terminal value. And if you add leverage to this analysis, assume a 65% loan to cost, there's actually a 52% difference in the return on equity between property one and property two. There are average yield on cost ranges that vary by property type, just like cap rates do. Yield on cost is not as volatile as cap rates are, but there are sort of expected ranges by different property types. You can see some of them listed on the slide in front of you. What I want to point out here is that self-storage and office industrial flex properties, and particularly I'm referring to our portfolio, which obviously I know intimately, has a much higher yield on cost than almost any other type of traditional real estate. Why is that, you may ask? There are a number of reasons. First of all, the cost to construct and the ratio of that cost to construct to what the markets will bear as rents per square foot is extraordinarily high in the self-storage and office industrial flex industries. Secondly, these two property types have lower operating and lower CapEx expenses than most types of real estate, which allows them to produce an NOI that on average is between 65 and 70% of gross revenue. So you have above average gross revenue per square foot, below average cost per square foot, which results in higher yields on cost. In our portfolio, sort of very simple model would be a cost to develop, including land cost at around $100 a square foot, with average gross rents of $15 a foot and operating expenses at 35% of revenue. If you do that math, it results in an average yield on cost of 9.75%, which is consistent with what we see in that 9 to 11 range within our portfolio. I also want to point out two other things. We have a couple of advantages in our strategy. First of all, our construction function is vertically integrated, so we're able to deliver product at a 10 to 15% cost below what most developers do who use outside general contractors. And the second piece is just a strategy for us. I'm sure you're very familiar with the multi-story, all climate-controlled storage facilities that have been popping up all around the country. We've opted not to build that product. We only build single-story drive-up self-storage. We focus on city skirt markets that are supported by major metropolitan areas where land is less expensive and regulations are a little easier to navigate. And we build single story drive up because we can build at $100 a foot. Those multi-story all climate control facilities you see cost in the range of $180 to $200 per square foot because they have to include sprinklers, they have to include elevators. And at the end of the day, while they do get a rent premium above what we get for our spaces, I can assure you it's not twice what we get. And so the single story drive up product delivers a higher yield on cost and therefore a bigger spread between the cost to construct and the market value once stabilized than the multi-story projects do. Let's move on and talk about development spread for a minute. As I said at the beginning, development spread is a derivative of yield on cost. It uses yield on cost to calculate the development spread, and it is simply the yield on cost minus the current market cap rate for that type of property. And what it reveals is the value spread between cost and market value. It allows you to do a direct comparison of returns between property types, markets with different cap rates and different opportunities. And it factors in the variances in market valuation and their impact on your potential investment returns. To give you another simple example, we have a project at the top of that page that shows a 9.5% yield on cost, a market cap rate of 6.25%, which when you do the subtraction gives you a development spread of 3.25%. The multifamily project at the bottom has a yield on cost of 7, which is within that range for the multifamily world. A cap rate at 5% because multifamily certainly carries a lower cap rate in most market environments than self-storage does. And that results in a development spread of 2%. If we assume both of these projects were $10 million projects, the self-storage project has a value creation, the difference between cost and market value of $5.2 million. And the multifamily project has a value spread between cost and market value of $4 million. It just gives you a simple example of how development spread can help reveal potential future investment returns. Let me give you a couple more simple examples of how you can use development spread and yield on cost to evaluate opportunities. In this case, it's two different development opportunities, one in self-storage, one in multifamily. Both are $10 million projects. You can see the corresponding yield on cost and therefore the resulting NOI that's projected for each project. If we assume that both of them require $3 million worth of equity, and we assume a market cap rate at exit, you can see then the development spread of 3.75% on the self-storage opportunity and 2.2% on the multifamily opportunity. That would indicate a project value at exit of $16,250,000 on the self-storage project and $14,400,000 on the multifamily project. If we assume a holding period for each of these projects to develop and stabilize them is the same, the self-storage investment provides a 33% internal rate of return, the multifamily investment a 25% of return. 25% internal rate of return. And the question that you have to ask yourself at this point is what is the difference in risk between these two, the outcome that's shown in these two projects? Is there a substantial difference in the risk? Is the multifamily project in a market that has huge demand for multifamily and very little competitive construction? In a sense, it's almost a sure thing. That might make you gravitate to the slightly lower return because of the less risk. But you have to add this. You have to add the subjective view of risk to that analysis. But this just gives you the numbers. Here's one last example. This is comparing two self-storage opportunities. One that is a development opportunity. The other is the ability to acquire, the opportunity to acquire an existing facility. Once again, both have a cost of $10 million. Yield on cost on the development project is 9.75%, which indicates an NOI of $975,000. The acquisition project doesn't have a yield on cost, but it is bought at a cap rate. We assume in this example it was a slightly favorable cap rate at 6.5, so which would indicate that property is generating $650,000 of net operating income. If we assume they're both levered at the same in the same way and therefore have the same equity requirement, and they're both going to be exited at a 6 cap, we have a development spread on self-storage development opportunity of 3.75%. And on the acquisition, you don't actually have a true development spread, but we have a difference between the cap rate that we purchased it for and the cap rate that we're projecting a sale for. So we have a spread of 50 basis points there. We also assumed in this example that the net operating income on the acquired property increases by 3% a year across a 5-year holding period. And at the end of that 5 years, you would have an indicated value on the development project of $16,250,000, and on the acquired project, just a little bit over $12 million. The resulting IRR on the development project is 25%. On the self-storage acquisition project, a 14% IRR. And once again, the question you have to ask here is, which one of these fits my investment objectives the best? And is there a substantial difference in the risk between the two? And if the storage development opportunity is more risky, is the risk supported by the additional return? As we close, I'll just summarize and say that the use of yield on cost and development spread adds additional perspective to whatever analysis or evaluation that you may be doing as you look at real estate opportunities today. It allows for comparisons across different property types, across different markets, across different cap rate environments. However, it is dependent on the quality of the assumptions that are used in the costing of a project and the projections of net operating income. And it also is based on the probability of the projected outcome. So you have to always factor in that subjective view of risk as you're comparing two projects. We believe that higher yield on cost and development spread that are available in self-storage and office industrial flex properties delivers higher risk-adjusted returns. Our investment strategy is based on the following things. The fundamentals in the office industrial flex market and self-storage are extraordinarily strong. We do believe they consistently deliver higher risk-adjusted returns. At AAA, we're an experienced developer and operator, and as we've already looked at, we have a 30-year track record of delivering a 19% IRR to our investors. And I'm excited to tell you that later this fall, we'll be back to present our current offering for left field investors, the left field investor community to consider. I do want to thank you for spending 15 or 20 minutes with us today. As a thank you, if you're interested, we'd love to send you our most recent report on the self-storage industry. All you need to do is reach out to Andrew Frohline, our Director of Investor Relations. His phone number and email address are there on the screens, or you can feel free to reach out to me directly, and we'd be happy to send you a copy of our most recent industry report. I'd also encourage you to take a few minutes and visit AAAStorageInvestments.com. That website will give you a little bit more information about the exciting things that we have going on at AAA. And lastly, I want to thank you for your time and your interest. Have a great day.